Everyone says Bitcoin ETFs pump the price, but nobody explains how. Let's break down what actually happens behind the scenes and why ETFs can push Bitcoin up or crash it just as fast. A Bitcoin ETF is simple. Investors buy ETF shares. ETF provider must buy real Bitcoin to back those shares. That means every ETF inflow is real BTC removed from the market, reducing supply. But here's the part most people don't understand. ETFs don't buy Bitcoin like traders do. They buy in huge blocks called creation units, usually millions of dollars at a time. Each ETF inflow forces institutions to buy massive chunks of BTC from exchanges. This drains liquidity, and when liquidity is low, price jumps fast. There's also a hidden loop. Inflow, higher price. More FOMO, more inflow, higher price again. This is why Bitcoin pumps so aggressively in early 2024 to 2025 on ETFs, accidentally created a self-reinforcing bull cycle. Everyone thinks ETFs only pump, but outflows can be brutal. When investors sell ETF shares, the ETF must sell real Bitcoin to maintain balance. And again, they don't sell small, they sell in monster blocks. Large outflows, ETF dumps BTC, liquidity thins, price dumps harder. And here's where it gets spicy. Wall Street knows ETF flows move Bitcoin, so market makers front-run the expected inflows and outflows. If they see ETF inflows rising, they buy early. If flows slow, they hedge or short early. This means ETF flow data basically telegraphs the next big move. In fact, ETF flows are now the #1 leading indicator for Bitcoin. Not RSI, not MACD, not moving averages. If ETF inflows rise, Bitcoin goes up. If inflows stall, Bitcoin ranges. If outflows hit, Bitcoin drops. So next time someone says Bitcoin is pumping, don't look at the chart. Look at the ETF flow data, because in 2025, ETFs aren't just part of the market. They are the market. This is Stick First Crypto, where we break down the real game behind every candle.